Hello, I'm Daniel Reeves, and welcome to the Metals Thesis, a channel dedicated to real data-driven analysis of gold, silver, and the forces shaping the metals market. Here we move beyond headlines to examine structure, trends, and the logic behind price movements. If you're looking for grounded insights instead of noise, you're in the right place. Let's start today's analysis by first examining the key developments shaping the current market environment. It's Friday, the 27th of February. Gold's powerful start to the year may have slowed, but according to one market analyst, the structural forces supporting the precious metals market remain firmly intact and are increasingly favoring gold over silver. In a recent interview with Kitco News, Nitesh Shah, head of Commodities and Macroeconomic Research at WisdomTree, outlined why he believes gold appears better positioned than silver in the months ahead, even as both metals continue to navigate a volatile macroeconomic backdrop. While price momentum has cooled following January's sharp rally and subsequent pullback, Shah emphasized that the broader structural drivers underpinning gold remain in place and continue to provide support for the yellow metal. After surging strongly at the beginning of the year and then experiencing a sudden retreat, gold has entered what Shah described as a period of relative calm. Prices have been consolidating above the $5,100 level following the earlier volatility. Shah characterized last month's momentum as unusually speculative in nature. He pointed to the scale of price swings as evidence of heightened activity, noting that gold experienced more volatility than Bitcoin during that period. He described this as an abnormal development, stating that such comparative volatility between gold and Bitcoin is not typical under normal market conditions. Despite that speculative episode, Shah indicated that gold is benefiting from what he described as an expanded scale of buyers. He highlighted the growing participation of Chinese insurance companies and pension funds, as well as continued demand from central banks. In addition to these traditional sources of demand, Shah also referenced interest in tokenized and digital forms of gold, suggesting that demand channels have broadened in recent months. According to Shah, this expansion of buyers represents an important structural support for gold, even as short-term volatility persists. Another factor Shah cited as supportive of gold is the continued presence of fears surrounding fiscal dominance. Fiscal dominance refers to the concern that central banks may ultimately be compelled to accommodate rising and potentially unsustainable levels of government borrowing. According to Shah, these concerns remain active in the current environment and continue to provide structural support for gold prices. The perception that central banks may be constrained by fiscal realities adds to gold's appeal as a monetary asset during periods of economic uncertainty. Shah also pointed to activity in the options market as an indicator of persistent bullish sentiment toward gold. He noted that call options at levels around $10,000 and $15,000 have attracted what he described as decent volume in open interest. He characterized these positions as resembling lottery-style bets, reflecting a mindset among some investors that in the current environment, almost anything could happen. While these positions may represent speculative sentiment, their presence in the market underscores continued interest in potential upside scenarios for gold. At the same time, Shah made clear that while gold's consolidation appears constructive, silver may face a more complex outlook. He stated that silver's recent performance has been particularly strong, which may leave it more vulnerable in comparison. When examining the gold-silver ratio, Shah observed that it currently sits well below its historic average. According to him, this suggests that silver is relatively expensive compared to gold at present levels. The relative valuation between the two metals is therefore an important consideration for investors assessing positioning. Unlike gold, whose demand is overwhelmingly driven by monetary and investment considerations, silver has a much larger industrial component to its demand profile. Shah expressed concern that silver's industrial demand could face challenges if prices remain elevated. He noted that because silver is more heavily tied to industrial usage, higher prices could potentially dampen demand in the real economy. This dynamic, he suggested, introduces an additional layer of vulnerability for silver that gold does not face to the same extent. As a result, Shah indicated that he would not be surprised to see silver weaken relative to gold through the remainder of the year. He stated that he expects the gold-silver ratio to move back toward a range between 60 and 70 points. That potential shift would imply a relative strengthening of gold compared to silver from current levels. While he did not provide a specific timeline beyond the remainder of the year, the expectation reflects his broader view that gold remains structurally better positioned. There is, however, one factor that could complicate that outlook. Shah acknowledged that retail investors may continue to favor silver due to its lower absolute price. Even if broader fundamentals appear to favor gold, he noted that demand for silver coins and bars could remain firm because silver may appear more affordable to individual investors. This dynamic represents a wild card that could influence relative performance between the two metals. As gold consolidates above $5,100 and investors assess the broader macroeconomic environment, attention remains focused on what could reignite upward momentum and potentially push prices back toward last month's record highs. Shah emphasized that global monetary policy remains central to this outlook, particularly actions taken by the Federal Reserve. While gold's structural supports remain in place, he suggested that developments in monetary policy will be key in determining the next phase of price movement. As investors continue to evaluate the outlook for precious metals, Nitesh Shah underscored that global monetary policy remains a central factor in determining gold's next directional move. In his interview with Kitco News, Shah explained that while gold has entered a period of consolidation above the $1,500 level following January's volatility, the broader macroeconomic environment continues to evolve. He emphasized that monetary policy decisions, particularly those led by the United States Federal Reserve, remain critical to understanding how the market may develop in the months ahead. According to Shah, although the Federal Reserve is currently maintaining what appears to be a relatively neutral stance, this posture cannot be assessed in isolation from broader fiscal conditions unfolding around the world. The U.S. Central Bank has shown no urgency in cutting interest rates ahead of the summer period, maintaining its current policy settings while monitoring economic data. Shah pointed out that this neutral approach reflects the Federal Reserve's present assessment of economic conditions. However, he stressed that monetary policy cannot be evaluated without considering fiscal realities. Rising government debt levels, both in the United States and globally, form a significant part of the broader context shaping gold's structural appeal. Shah stated clearly that debts are increasing across many economies. He suggested that if governments are unable to rein in those rising debt levels, central banks may ultimately be required to respond in some capacity. Shah described a scenario in which mounting debt obligations and rising debt servicing costs could create strain within bond markets. If debt payments become unsustainable and bond markets begin to show signs of disorder, he said, central banks would be compelled to act decisively. According to Shah, such action could take the form of interest rate cuts or alternative easing measures. In the current environment, he indicated that balance sheet expansion may represent a more politically acceptable path for central banks compared to other policy tools. This potential expansion of central bank balance sheets, he suggested, would likely continue to provide structural support for gold prices. Importantly, Shah emphasized that this dynamic is not limited to the United States. He pointed to developments in Japan under Prime Minister Sanai Takaichi, where the government is looking to stimulate the economy through significant fiscal measures. At the same time, European countries are continuing to expand deficit spending programs aimed at rebuilding infrastructure and strengthening military capabilities among member nations. These fiscal initiatives, according to Shah, contribute to a broader global trend of expanding government balance sheets. As governments increase spending and borrowing, the implications for monetary policy become increasingly significant. Shah explained that the expansion of global balance sheets is a key structural factor supporting gold. In his words, gold is unique because it possesses a fixed supply aspect. This characteristic distinguishes gold from fiat currencies and from many financial assets whose supply can be expanded through policy decisions. As central bank balance sheets grow and fiscal spending increases, gold's limited supply remains unchanged. According to Shah, this structural feature enhances gold's appeal in an environment characterized by rising debt levels and ongoing fiscal expansion. At the same time, Shah noted that broader economic uncertainty continues to weigh on global markets. He stated that despite elevated prices, allocations to both gold and silver remain extremely low in many portfolios. According to him, there is significant room for growth in investor exposure to precious metals. Even with prices having risen, he suggested that overall positioning remains modest relative to historical norms and relative to the scale of global financial markets. This gap between current allocations and potential optimal holdings represents another structural factor that could influence the market. Shah highlighted portfolio positioning as a potentially powerful driver for precious metals moving forward. He explained that many institutional investors currently hold minimal exposure to gold. In this context, even relatively small shifts in allocation could have a material impact. He referenced quantitative analysis conducted on gold markets, indicating that optimal portfolio holdings could be somewhere in the range of 15 to 20% allocated to gold. According to Shah, few investors currently maintain allocations anywhere near those levels. He noted that even a doubling of allocation from 1% to 2% could have a meaningful effect on a market that is small compared to global bond and equity markets. This observation underscores the structural nature of potential demand growth. Shah did not suggest that such allocation shifts are imminent, but he emphasized that the size of the gold market relative to global financial assets means that incremental changes can have outsized consequences. In markets where supply is relatively fixed and total capitalization is small compared to equities and bonds, additional inflows can exert significant upward pressure. According to Shah, this dynamic is an important consideration when assessing the longer-term outlook for gold. While much of the focus remains on gold's monetary characteristics, Shah reiterated that silver's outlook is more complex due to its industrial exposure. Silver's dual role as both a monetary metal and an industrial commodity means that its performance is tied not only to investment demand but also to economic activity. Elevated prices, he cautioned, could potentially dampen industrial usage. This distinction between gold and silver is central to Shah's relative preference for gold in the current environment. Gold's demand profile, being predominantly monetary and investment-driven, may prove more resilient amid macroeconomic uncertainty and fiscal expansion. Nevertheless, Shah acknowledged that retail investor behavior introduces an additional variable. Silver's lower absolute price can make it appear more accessible to individual investors purchasing coins and bars. Even if broader fundamentals favor gold, sustained retail demand for silver products could provide support. This factor, he suggested, represents a wild card within the broader precious metals landscape. As global fiscal programs expand, central bank balance sheets potentially grow, and institutional investors reconsider portfolio allocations, Shah maintains that the structural backdrop remains supportive for gold. The interplay between monetary policy, fiscal expansion, and portfolio positioning continues to shape the environment in which both gold and silver operate. In this evolving context, gold's fixed supply and monetary characteristics position it, in Shah's view, as the metal better aligned with the prevailing structural forces. As the broader macroeconomic environment continues to develop, Nitesh Shah's assessment places considerable emphasis on the structural contrast between gold and silver, particularly in light of recent market performance. Following January's sharp rally and subsequent pullback, gold has transitioned into what he described as a more stable phase, consolidating above the $5,100 level. While that earlier surge was marked by heightened volatility, Shah characterized the momentum as unusually speculative. He pointed out that during that period, gold experienced more volatility than Bitcoin, a comparison he described as abnormal. Such behavior, in his view, signaled an environment influenced heavily by short-term positioning rather than purely fundamental drivers. Despite that volatility, Shah's analysis suggests that the cooling of gold's rally does not represent a breakdown in its underlying support. Instead, he described the current consolidation as potentially constructive. Markets often move through phases of expansion and consolidation, and Shah indicated that the recent period may represent a necessary adjustment following speculative excess. He noted that it may take additional time for what he described as froth to work its way out of the system. However, he did not indicate that the broader structural case for gold had weakened. Central to Shah's argument is the notion that gold is benefiting from an expanded scale of buyers. He specifically referenced increased participation from Chinese insurance companies and pension funds. He also highlighted ongoing purchases by central banks, which have been active participants in the gold market. In addition, Shah noted demand emerging through tokenized and digital gold products. This combination of traditional institutional buyers, official sector demand, and newer digital avenues represents a broadening of participation. According to Shah, this expanded demand base strengthens the structural foundation supporting gold prices. In parallel, Shah pointed to the ongoing relevance of fiscal dominance concerns. Fiscal dominance refers to the situation in which central banks may feel compelled to accommodate government borrowing needs rather than operate independently with a singular focus on inflation or employment mandates. As debt levels rise across various economies, Shah indicated that the potential for central banks to adjust policy in response to fiscal pressures remains an important consideration. This backdrop, he suggested, continues to provide support for gold as a monetary asset. The options market also offers insight into investor sentiment. Shah observed that call options at levels around $10,000 and $15,000 have attracted notable open interest. He described these positions as resembling lottery-style bets, reflecting a belief among some participants that extreme outcomes are possible in the current environment. While such options activity may not reflect base case expectations, it does signal the presence of bullish sentiment and a willingness among some investors to position for substantial upside scenarios. In contrast, Shah expressed greater caution regarding silver's trajectory. He acknowledged that silver has delivered a particularly strong run. However, when evaluating the gold-silver ratio, he noted that it currently sits well below its historic average. According to Shah, this suggests that silver is relatively expensive compared to gold. The gold-silver ratio serves as a widely observed measure of relative valuation between the two metals. A reading below historical norms implies that silver has outperformed gold to a degree that may not be sustainable over time. Beyond valuation considerations, silver's industrial role introduces additional complexity. Unlike gold, whose demand is overwhelmingly monetary and investment-driven, silver is heavily utilized in industrial applications. Shah expressed concern that elevated prices could dampen industrial consumption. If companies face higher input costs due to rising silver prices, demand could potentially be constrained. This sensitivity to real economy conditions differentiates silver from gold and, in Shah's view, makes silver more vulnerable during periods of economic uncertainty or price spikes. Shah stated that he would not be surprised to see silver weaken relative to gold through the remainder of the year. He added that he expects the gold-silver ratio to move back toward a range between 60 and 70 points. Such a shift would imply a normalization from current levels and a relative strengthening of gold compared to silver. His expectation is rooted not in a dismissal of silver's appeal, but in the combination of valuation metrics and demand structure differences. At the same time, Shah acknowledged the presence of a wildcard factor. Retail investors may continue to favor silver due to its lower absolute price. Silver coins and bars can appear more accessible to individual buyers when compared with the higher nominal price of gold. Even if broader fundamentals tilt in favor of gold, sustained retail interest in silver products could provide ongoing support. This dynamic adds nuance to the relative outlook and underscores the importance of considering both institutional and retail behavior. As attention turns to potential catalysts for renewed upward momentum in gold, Shah reiterated the importance of monitoring global monetary policy. While the Federal Reserve currently maintains a relatively neutral stance and appears in no immediate rush to cut interest rates before the summer, the broader fiscal environment remains a key variable. Shah emphasized that monetary policy cannot be separated from rising debt levels. If governments struggle to manage growing debt burdens, central banks may eventually need to respond. He outlined a scenario in which unsustainable debt payments and disorderly bond markets could necessitate bold action. Such action could include rate cuts or other forms of easing. In the current political and economic climate, Shah suggested that balance sheet expansion may represent a more feasible route. As central banks expand their balance sheets, liquidity conditions change, and the relative appeal of hard assets such as gold may increase. Shah also highlighted that this issue extends beyond the United States. Japan, under Prime Minister Sanai Takaichi, is pursuing significant fiscal measures aimed at stimulating its economy. Meanwhile, European nations continue to expand deficit spending programs focused on infrastructure rebuilding and strengthening military capabilities. These developments contribute to a broader pattern of fiscal expansion across major economies. According to Shah, the cumulative effect of expanding global balance sheets supports gold's structural case. As the broader discussion draws to a close, Nitesh Shah's outlook centers firmly on structural forces that he believes continue to favor gold within the precious metals market. While the early part of the year was marked by sharp gains followed by notable volatility, gold has since entered a period of consolidation above the $5,100 level. Shah characterized the earlier surge as unusually speculative, highlighting the fact that gold experienced more volatility than Bitcoin during that stretch, a development he described as not normal. However, despite that period of heightened activity, he did not indicate that the underlying drivers supporting gold have diminished. Instead, he suggested that the market may simply be working through the excesses generated during that rapid advance. According to Shah, one of the most significant structural supports for gold is the expansion in the scale and diversity of buyers. He referenced participation from Chinese insurance companies and pension funds, continued demand from central banks, and interest in tokenized and digital forms of gold. This broader base of demand represents a meaningful shift compared to more narrowly concentrated participation. In his view, the presence of these varied buyers contributes to the stability of gold's longer-term foundation, even as short-term fluctuations occur. Shah also reiterated that fears of fiscal dominance remain active within the current macroeconomic environment. Rising government debt levels across multiple economies have intensified concerns that central banks may eventually need to accommodate borrowing pressures. If governments are unable to rein in debt growth, central banks may be forced to react in some manner. Shah stated that when debt payments become unsustainable and bond markets become disorganized, central banks would have to act boldly. That action could take the form of rate cuts or other easing measures. In the present political climate, he suggested that balance sheet expansion may be viewed as the more politically acceptable approach. Importantly, Shah emphasized that these dynamics are not confined to the United States. Japan, under Prime Minister Sanai Takaichi, is pursuing significant fiscal measures aimed at stimulating its economy. At the same time, European countries continue expanding deficit spending programs focused on infrastructure rebuilding and strengthening military capabilities among member states. The expansion of global balance sheets, according to Shah, remains a structural force supporting gold prices. He underscored that gold possesses a fixed supply aspect, distinguishing it from fiat currencies and financial assets that can be expanded through policy decisions. While gold's structural case appears solid in Shah's assessment, he expressed comparatively greater caution towards silver. He noted that silver has already experienced a strong run and that the gold-silver ratio currently sits well below its historic average. In his view, this suggests that silver is relatively expensive compared to gold. Unlike gold, whose demand is primarily monetary and investment-driven, silver has substantial industrial demand exposure. Shah expressed concern that higher prices could potentially choke off industrial demand if companies respond to increased costs by adjusting consumption. This difference in demand structure forms a central part of his relative preference for gold. Shah stated that he would not be surprised to see silver weaken relative to gold through the remainder of the year. He expects the gold-silver ratio to move back toward a range between 60 and 70 points. At the same time, he acknowledged the presence of a wild card. Retail investors may continue favoring silver because it appears cheaper in absolute terms. Demand for silver coins and bars could remain firm even if broader fundamentals lean toward gold. This dynamic introduces an element of uncertainty within the relative performance outlook. Beyond immediate price considerations, Shah highlighted the role of portfolio positioning as a potentially powerful structural driver. He stated that allocations to both gold and silver remain extremely low despite elevated prices. According to him, many institutional investors hold minimal exposure to precious metals. He referenced quantitative analysis indicating that optimal portfolio holdings could be somewhere close to 15 to 20% in gold. However, he noted that few investors maintain allocations anywhere near that level. Even a doubling from 1% to 2%, he explained, can have a material impact in a market that is small relative to global bond and equity markets. This observation underscores the broader context within which gold operates. The gold market is modest in size compared with global financial assets. As a result, incremental shifts in allocation can produce disproportionate effects. Shah's comments suggest that structural drivers, including expanded buyer participation, fiscal pressures, monetary policy considerations, and low existing portfolio allocations, collectively form the foundation of his outlook. While short-term volatility may continue, these underlying forces remain intact. In summary, Shah's analysis presents a measured but structurally supportive view of gold. The metal has moved into a phase of consolidation following a speculative surge, yet expanded buyer participation and ongoing fiscal concerns continue to provide support. Global debt levels are rising, and fiscal expansion is evident across major economies, including the United States, Japan, and Europe. Central bank responses to these realities may involve rate cuts or balance sheet expansion. Gold's fixed supply characteristic positions it uniquely within this environment. By contrast, silver's stronger recent performance, its relative valuation, and its industrial demand exposure introduce additional vulnerability, even as retail interest may remain firm. Throughout his assessment, Shah maintained a focus on structural factors rather than short-term price movements. He emphasized that portfolio positioning remains low and that even modest allocation shifts could influence the market. As global economic uncertainty persists and fiscal realities continue to shape monetary policy decisions, gold's role as a monetary asset remains central to his outlook. While volatility may continue in the near term, the broader structural forces he outlined remain firmly in place.